listening to Her Profit Era, the podcast for founders who want a business that actually works, a business that's profitable, predictable, and pays them well. I'm Cindy Kumar, a CPA, a fractional CFO from Abbotsford, BC, Canada. I'm the person founders call when they're tired of high revenue months with no money left over. I started this podcast because too many founders were chasing sales while their margins, cash flow, and bank accounts told a completely different story. I believe profit and money in the bank is the standard, not a bonus, and that every founder deserves clarity around their numbers. Each week, you'll get real financial strategy you can actually use and honest conversations with founders and industry experts about what it really takes to build a business that lasts. On this week's episode of Our Profit Era, I'm sitting down with Farrah Turcotte, a mortgage broker and money coach who's really focused on making money actually make sense. Farrah is someone who's bridging the gap between all the confusing financial advice out there and what people actually need, especially when it comes to buying a home. She's built a platform around simplifying personal finances with over 150,000 podcast downloads and a growing community online. And what I like about her approach is she's making things practical. In this episode, we're getting into what people in BC actually need to know if they're thinking about buying a home. Because a lot of people are just guessing. They don't really understand how mortgages work, how to qualify, what lenders are looking for. And we're also getting into the side I see with my clients all the time. How are you managing money? How are you structuring your income? And it all plays a role whether you can actually get approved. So if buying a home is something you've been thinking about or you're confused by the whole mortgage process, then this episode will give you a lot of clarity. So let's get into it. Hi, Farrah. Thanks so much for joining me on Her Profit Era today.
Hi, Cindy. Thanks for having me. I'm so
I'm
excited to be here.
I'm so excited too. I feel like mortgages, like finances and taxes, there's so much information out there, but we just don't know what applies to us.
So true. And you're getting information from so many different sources,
So
or the
true.
specific thing you're wanting to know isn't out there. So many different situations and scenarios. So I'm happy to share what I know.
What got you into like mortgages and even like money coaching?
Yeah, well, mortgages specifically, when I purchased my first home, I had a really good experience with my mortgage broker. And at that time, I was money coaching, and I found myself really like nerding out in the process, probably more than the average mortgage client,
Yeah.
asking my mortgage broker, all these questions, and also just wanting to pick his brain about what it was like as a career. And that at that time, it really piqued my interest. And I really wanted to be able to deliver the same level of service to my clients in the future. And I know, especially for first time home buyers, there's like so many questions that come up, questions that when you
Right.
start, you might not even know that you'll have. So that's how I started mortgage brokering. And money coaching, I went through, periods of time, like especially throughout university, with getting myself into credit card debt, not really knowing how to budget, not really having any financial literacy. And at that time, especially, there wasn't really much content out there as far as content that was like jargon free or like simpler, easier to understand. This was pre-COVID. So then when COVID hit, I found myself working from home, not going anywhere. And I was like, I really want to start sharing more like personal finance content. And there's got to be people out there who might have had a similar experience as to me. And I want to show them, simpler systems that they can sustainably use moving forward to manage their money. So, and then I became a huge money nerd as a result. Yeah.
That's so awesome. And what are some like tips you can give someone if they're just starting to look for a property or a home? Because I know a lot of times when you start looking for a home, it's like all of a sudden you're in reactive mode. You're just like, I just need to find anybody, especially going to like a bank person versus like an independent broker. So what does that kind of look like?
Yeah, I think right off the bat, you should start the conversation with a mortgage broker. Obviously, I'm biased because I am a mortgage broker, but I will
Yeah.
say this. I think it's really important that before you even start looking, you have an idea of what you qualify for, what sort of range you should be looking at properties in. Because, like, I remember when I first started looking, this was before talking to a broker. I was looking at properties that were way out of my qualification. I was like, oh, this looks great. And then my pre-approval came back and it was lower than I had anticipated. So I kind of like to compare it to when you, like, let's say you're getting married and you're trying on wedding dresses. You
Yeah.
don't want to try on the dress that is outside of your budget because
You fall in
just
love with it.
you'll fall in love with it. And just like when you go into a home that might be outside of your budget, you fall in love with it, the emotions take over,
Right.
and you might find yourself, trying to negotiate with yourself on how you can make it work. Maybe you can't even make it work because it's not even something that you'd be approved for.
Yeah.
So engage with the mortgage broker. They'll tell you, what your options are. If maybe you're not ready to buy right at this moment, they can help you. Something that I like to include as part of my practice is like, maybe you're not ready now, but here's what you can do to get there. So it's not a no, never. It's just maybe a not right now. Um, talk to talk to a realtor, like interview different realtors, see who you like, trust, get along with, that maybe knows the area really, really well. And the last thing I would really, really want to stress, like, I think in the past, we've seen, people have seen real estate prices, like especially in the lower mainland and greater Vancouver, crazily rise. And they're like, oh my God, I'm going to buy a home and it's going to increase 10% in value every single year.
Yeah.
And that's not the norm. So, like, I want to throw that out there.
Yeah.
And so when you are looking at homes, you really got to ask yourself, like, is this somewhere that you can see yourself living for 5, 10 years down the line? If values decrease and you need to sell, would you sell at a loss? Like that, those are all things to consider. So, could you stick it out and stay in this place for a long time, is what I would think about. Yeah.
That's such great advice. And is there a way to figure out like how much you would qualify for? Like, is there a calculation or some kind of resource?
Yeah, there are. I do have a mortgage calculator app. And there are lots of calculators out there as well. The Government of Canada has one. There's also a few on the CMA Mortgage Hub that I like to also look at. But the thing is, those calculators may not take into account like the unique aspects of your situation. Like they'll take your income and down payment, that sort of thing, but there are unique circumstances like are you full time? Are you part time? Are you a contractor? Are you self employed? Are you a sole proprietor? Are you incorporated? Um, and so those are also going to be things that affect your income, your ability to qualify. Lenders, may want to see a 2-year average for one person, but then want to see the salary on a letter of employment for another if you're permanent full time. So, like, there are so many little nuances that I think that's why you want to work with a broker who can work with those specific details because no two applications are the same. Yeah.
From what you've seen, is it easier to qualify for a mortgage if you work full time and your income's like consistent year over year versus being like self-employed or owning a corporation where your income might change drastically year over year?
Yes and no. So it's easier when you are a permanent full-time salary employee as far as we will take the income that shows on your letter of employment,
Right.
pay stubs that match the pay on the letter of employment, fairly, straightforward to calculate. Whereas, like, if you're self-employed, you might want, maybe you claim a lot of expenses on your T1 generals. Maybe but maybe you have a high amount of business bank deposits. And then maybe we go an alternative route where we do 12 months of your business banking deposits added
Wow.
up, less regular expenses. So maybe the salaried employee, has a more easier salary to qualify with, but maybe it's less than the person who is self-employed. So then that's like maybe there can be different ways to structure your application depending on what type of job you have or business. Yeah.
Totally makes sense. Another question I always hear about is like, what's the difference between like variable and fixed mortgages, and like, how do you decide between the two?
It's a really good question. So, um, variable rates. So there's like two different types of variable mortgages you can have. So there's like a static payment variable and then an adjustable rate variable mortgage. So a static payment, your payment will always stay the same regardless of what the interest rate does. If it increases, though, more of your payment goes to interest, less to the principal. And then with a adjustable variable rate, then as the Bank of Canada prime rate increases or decreases, so does your interest rate and so does your payment along with that. So the thing about static is that it's great, it stays the same, and so it's a little bit easier when it comes to budgeting. Maybe you're looking for something a little bit more stable out of the two. But let's say the Bank of Canada prime rate rises so much that now none of your payment goes to your principal, you'll
Yeah.
hit a trigger rate. And so that can be a bit of a wake up call. That has happened to quite a few people, especially like over like 2022, 2023, where we saw variable rates rise really significantly.
Right.
So that could be that could be an issue. And then fixed is nice because it is stable, predictable. You don't have to, like, if you're somebody who cannot sleep at night, if your interest rate was to change or go up, like,
Yeah.
I would suggest you go with fixed. Especially for first-time home buyers, like, especially if you're going to be there, at least for the next 3 years, 5 years, fixed is nice for that stability and predictability, not having to worry too much about that. But then the caveat is if you do go fixed, um, the way that your lender calculates penalty, like if you need to refinance, if you need to, maybe you want to sell and you don't want to port the mortgage and you need to break it in any way, variable penalty is like typically 3 months interest,
Oh, wow.
where whereas fixed, it is the greater of either 3 months interest or what we call the IRD or interest rate differential. And that might sound like a whole load of jargon, but essentially what that means is the lender's going to look at what your current fixed rate is what their current posted rates are and compare. Because if you break like a mortgage that has a higher interest rate than what they have now, they're losing money by you
So true.
bouncing. So they take a look at the difference between those rates, and they also look at how much time you have left in your term as well to determine a penalty. So those that can add up. It can be some higher significantly sometimes compared to variable. So just some food for thought. Yeah.
Based on like the clients you're working with, are you seeing that people are opting for fixed or variable, or has it been like a mix?
It's honestly been a mix just because, like, right now, variable rates, like the Bank of Canada has held rates pretty steadily here.
Yeah.
But then there's also, I think, the people who feel a little burned by what happened in the past.
Yeah.
So, um, I think first-time home buyers, a lot that I'm working with are going fixed, which I totally get.
Yeah.
But there's like a mix. There's some people who felt burned by the rate increases, and then there's also the people who are like, well, I already rode the wave up and down, so whatever, I'm just gonna continue with variable. So just some things to think about.
I guess it varies person to person.
Totally, yeah.
And with like down payments, is there like a fixed percentage someone would have to pay, or does it vary like per property or like the value?
Well, when it comes to minimum, it's minimum 5% on the first 500,000 and
Okay.
then 10% on the portion above 500,000 to like a million.
Yeah.
So that's the minimum. But then if you are someone that wants to work or needs to work with a B lender, for example, you're going to need to have at least 20% down um, in order, for example, to use the business bank deposits approach for like a business owner. And then, for some people at minimum down, you might not qualify based on your income and your employment. So maybe due to the amount of debt you might be carrying or how much income you're making, you might be needing to place more down in order to qualify. So not everyone can put the minimum, but not everyone can actually get approved with the minimum. Yeah.
That makes sense. And then in terms of like getting pre-approved, like how much impact does like your credit score play?
Oh, so I like to say your mortgage application is like a smorgasbord, okay? Like it's not like the lender only looks at your credit and nothing else. And it's not like the lender only looks at your income and nothing else. It's like it needs to be this cohesive application with all the different elements. So, yes, credit is a really important part. So, they're going to look at your credit report, they're going to look at your score, they're going to look to see if you've been making payments on time. If they've been late, how late were they, and how long ago were those late payments? Is there an explanation for it?
Yeah.
Have you ever had a consumer proposal? Have you ever had a bankruptcy? Um, that sort of thing. So, and they also even look to see things like on your credit report, especially for married women who've changed their last name, like, do your names match? Do they not? Are we going to need a marriage license? Like,
Wow.
that's all the identity stuff too is really big.
Yeah.
So yes, ideally, if you want ideal rates, you're gonna want to aim to be at least at a 680 score to have access to the best rates.
That totally makes sense. And have you seen situations where, for the mortgage purposes, they'll want you to pay off like your credit card balances and like any outstanding loans before they approve you?
Yes. So in some cases, so one of the things we look at is what we call GDS and TDS, or gross debt servicing and total debt servicing. Um, And total debt servicing is your gross household income in comparison to your housing costs, so mortgage, property taxes, strata fees, if any,
Yeah.
heating costs, and then also your monthly liabilities or the debts you're paying. So for credit cards, we have to look at 3% of your balance per month. Even if you're, on a low interest rate credit card, we look at 3%. So in some cases, if somebody were to not pay out all of their debts, their debt servicing percentage might be too high and it would be a decline and it wouldn't be approved. But if they were to pay out some of those debts, then the application works and would potentially be approved. So there's that. Or, there's been cases where a lender might see that you have like a really high, large amount of credit available to you. And maybe they might ask you to close like a line of credit or something. That doesn't happen very often, but it's just like something to keep in mind. Just like throughout the process, unless you're paying off, unless you're paying off debt, I would be like, do not make any changes to your credit. Do not
Yeah.
get
Don't
a
apply
new,
for more loans.
no, please don't, like, if you're buying a home and you do not go and get a new car loan, you know, please don't. Yeah.
But if you do have like a car loan outstanding and you're thinking about like refinancing your vehicle or maybe changing up your lease, would you recommend not doing that either during the same time you're looking for properties?
Well, it's like you also want to take into account like I've worked with a client where in the past year they've had over like 20 credit inquiries. And so that might set off questions from a bank or a lender like why are they having, this sort of credit seeking behavior? Like what
Yeah.
is the purpose? Like should we be worried? Um, you can qualify with a car loan. It just has to work with the rest of your application. So, um, it will decrease your purchasing power as well.
Yeah.
Um, but sometimes for some people, like you might have to refinance your vehicle maybe to a lower interest rate in order to make your application fall in line and get approved. So there's that to consider as well. And with every application, your mortgage broker writes a lovely little essay, I guess you could say, about you or like notes about you and your specific situations. There are, exceptions are never promised. They're exceptions, of course. Um, get you a broker who will go to bat for you, fight for you, and write some really nice things about you or like show and make sure you answer their questions when they ask about credit. That's all I gotta say. Yeah.
And what does like the average timeline look like when someone reaches out to you and gets like approved? Because I know that can vary as well.
Oh, it can vary
Yeah.
greatly. Like, I've worked with clients who started to reach out with me like over a year before they closed on their home. So I'm happy to be there throughout the whole journey from start to finish and beyond. And I've had clients reach out to me who literally are putting in an offer the next day and
Wow.
need to get things moving. So
Yeah.
it totally is all over, but I'm happy to come in whenever I can.
What's the difference with like working with you compared to like someone at the bank?
Okay, so that's a really good question. Um, and keep in mind, you want to take what I say with a grain of salt, and then also if you go to a bank and you ask someone the same question, you want to take what they say as a grain of salt too. So I just want to throw that out there. Um, so when you work with a mortgage broker, like myself, we have access to dozens and dozens of different lenders. So if, let's say, we pull your credit report one time and maybe we take your file to one lender and it doesn't work, we can still use that same credit report to go to other different lenders. Different lenders and banks also have different rules and ways and guidelines of calculating things. Some lenders might have, like if you're buying a house with a rental suite, some lenders might calculate how they use that rental income to qualify you a little differently. So maybe you go with someone who has a more preferable way of incorporating that. Whereas um, on the bank side, you only work with them. And so if the file doesn't work with them, it's not like they can say, oh, like, why don't we try, another different bank, because they can't do that. You have to do that yourself.
Okay.
Um, and also, mortgage brokers do have access to some of the big banks too, like TD, BMO, Scotiabank, and also like Coast Capital in BC. And I think one thing I also want to throw out there is monoline lenders. They are mono, as in they deal with a singular product, which is mortgages. So they specialize in mortgages. It's all they do. But I think that a lot of people hear about them and it's not, a famous brand like a big bank, and they think it's
Yes.
a scam, or, it's not a trustworthy financial institution. But that's not the case. But you have to look at it as, a big bank. They pay for they have all kinds of products, right? They've got checking
Right.
accounts, investment accounts, etc. They have brick and mortar locations, whereas the monolines, they don't do any of that. It's just your mortgage. So, and they're just as safe. So that's something to consider. And what else was I going to say about this? Oh, yes. So, um, your broker also, I have clients who I happily respond to at 11 o'clock at night, on the weekend, whenever and wherever. Like, I am there for you anytime you have a question, and I'm happy to meet with you at any time. So there's that level of service that I think is lacking on the bank side,
Yes.
because if you work with the bank directly, what if you have a question on, a Saturday morning? Nobody is going to talk to you.
So true.
Um, if you have, and they might need you to book an in-person appointment to go in and talk to somebody, and not everybody wants to do that. Um, they have limited hours, so that's something to consider. And they can only sell you their own products. And also, a lot of the mortgage specialists within the banks are not licensed with the BCFSA. They haven't gone through the educational aspect as well. So, again, they can only offer you what
What
products
the
they
bank has.
have. Yeah. So,
That's
there
so
might be
interesting.
other solutions for you, but you just don't know about it.
So you're kind of limiting your options if you do go through.
Yeah. Yeah.
What's the difference between like A lending and B lending? Because I feel like a lot of times people are like, you shouldn't go with B lending at all.
So, B lending, okay, listen, there is a mortgage type and a time and a place for everyone. And I think B lending gets a really bad rap.
Yeah.
But you just have to look at it as like, we say it is an alternative lender, like it's an alternative solution.
Yeah.
Um, B lenders, yes, upfront, 100%, they have higher rates than A lenders. Um, but it can be a solution for someone who maybe they want to stay tax efficient, right? They're self-employed. Like I said, they are an option if you're self-employed and claim a lot of expenses, and so the income you have that is verifiable um, on your T1s or on your business financials is not what you need to buy the home that you want. But if you go with the B lender, we can look at those 12 months of your business bank deposits, and add that up to come up with a better actual look at what your income really is, to help you qualify. So that's like a good solution. Um, It can also be helpful if you have like a lower credit score or you have had, maybe some issues on your credit report that maybe an A lender won't consider, but you still want to purchase a home and maybe you have had made changes to, and you can really demonstrate that to a lender as well. So, like, you just got to look at it as it's an alternative solution, and also it's not forever. Like there are some B lenders who also are on the A side and they have like graduation programs. So let's say you do a 3-year term with the B lender and then now you can qualify on the A side. We can like transfer you over there. But another thing is that they typically have fees associated. So, a common charge is 1% of the mortgage balance that you'll have to pay for B lending. So there's that too.
Yeah.
But again, it's just another solution. It's another option. Yeah.
Is it easier to qualify for B lending compared to A?
Well, it can be just because they're debt servicing ratios. So when they look at your household income in comparison to housing costs and in comparison to your debts and your liabilities, they are a little bit more flexible with how much debt or how much house you can buy. Um, so there's that, but you do need to have at least 20% down to go with them.
That
Yeah.
makes sense.
Or 20% equity in your property.
Wow, I'm learning so much today.
I'm glad. Let me
Let's
know
say
if I get to mortgage jargony.
you're
Like
good.
that's what I do not want to do.
No, you're totally good. Let's say someone already has like their principal residence and they're thinking about buying a property as an investment. Is it harder to get a second mortgage and qualify?
Well, there's a few ways you could go about it. So if you need to refinance your current home and pull out equity in order to use as a down payment for the next home, um, then keep in mind that you also need to qualify as if you're carrying um, the original property and then also the second property. But then also we can take into account what rents you'd be receiving. Um, that can help you with your qualification as well. My answer is going to be probably the same for every question. It
Okay.
depends. It depends on your situation. So let's say you have to refinance your current home to use the money to buy the investment property, you're going to have to qualify based on the new mortgage on your current home and then also the mortgage on the investment property. But we can take things into account, like let's say, um, depending on how much rent you're receiving for the investment property, that can be included and help to um, offset some of the costs. Rental property or investment property interest rates also tend to be a little bit higher slightly than your principal residence. So that's something to keep in mind. So it does really depend, but the rent you receive can be helpful in determining what you qualify for. Yeah,
Makes sense. It's so hard to say because I guess it just varies like person to person what their credit
it
and everything
really
looks like.
does. Yes, your credit, your income, what your employment looks like, the actual property itself. Lenders look at to where is it located, if it's not tenanted right now, what are the market rents for that area or that property? So there's a lot of things that get taken into account when it comes to qualifying. Yeah.
That makes sense. What does it look like the client's journey working with you? Like from an initial, like do you do a phone call, you meet in person, like how much paperwork, like what's involved?
Yeah, so I usually do a phone call or a Google Meet just to get to know the clients, their situation. I do kind of explain to them at the beginning, I'm going to ask you a variety of questions just about your specific situation. And it does feel a little bit like a murder investigation, but I promise it's for a reason. I'm not asking you just for the sake of asking you. So I do take it really seriously that people share their like their financial story with me. Like it's really obviously really personal, and I don't take that lightly at all. So everything that clients share is always confidential. Um, so after the phone call, they will fill out an application. So details about their income, their job, how long they've been working there, where they're living, that sort of thing. And then also, then I'll send out a request for documentation I'll need. So that could vary person to person. Like if you're employed, letter of employment. If you're an incorporated business owner, I'll ask for your business financials, that sort of thing. Um, Once I have that, then I kind of go through the process where I look at your documents to kind of come up with a number for you as far as qualifying goes. And show you a few different options, like a few different lenders, a few different rates, few different term types like 3 year, 5 year, variable, fixed, that sort of thing.
Right.
And then send in your application for pre approval. And pre approval, like, is essentially I've done a thorough vetting of your documentation. We can hold your interest rate for 120 days while you go out and shop. And during this time, I'm talking to your realtor and,
Yeah.
we're staying in communication. I'm talking to you, seeing how things are going. Um, when you put in your offer, I'm like talking to your realtor right away. Like, I need the paperwork. Let's
Yeah.
go. Let's send it in. Um, and something that's really important to me is, especially when you are in the process of what we have, like what we call like a live file, which essentially means like you've put in an offer on a home and your offer's been accepted.
Mhm.
Like I know that's when your clients are, probably going to be feeling a little overwhelmed and like, you know, also questioning like, am I doing the right thing? And,
Yeah.
concerned and worried, and you're waiting to hear back from the bank or lender to see if you've been approved. But I make sure that I stay in touch with you every single day and make sure that I keep you posted with any updates. Even if there's no update, I'll send you an update. So it can be a lengthy process depending on, when you initially reach out to me. Like I said, it could be a year out, 2 years out. Doesn't matter to me. I'm just here to ensure that, if you have a question, you get an answer. So, yeah.
That totally makes sense. And what are your thoughts on people like shopping around, working with different brokers, filling out different applications? Like, does that impact you getting approved for a mortgage? Like, when
Yeah,
you
like
like fill out an application and send it, can like the lender see that there's multiple applications going through?
yeah, so or keep in mind they see your credit bureau, so they can
Okay.
see if your credit's been pulled multiple times and by who and from where. So that's like something to keep in mind. Mortgage brokers, mortgage brokers, like I think it's really important that you work, feel free to talk to a few different mortgage brokers, see, ask your friends and family, find them in Facebook groups, maybe talk to a few, see who you vibe with, who you gel with, that sort of thing. But I mean, mortgage brokers typically have access to all this, like same lenders, same rates. Um, so there's not going to be like a vastly huge difference as far as what mortgages they can offer you.
Yeah.
But I think it's important that you vibe with someone, right? And
Right.
that it's someone that you like, you trust, that sort of thing. Um, and then when it comes to the banks, if you're going there, I think similar thing too. One thing I will add though, and I just will add this about the bank versus broker thing,
Yeah.
is um, you don't know if your mortgage specialist you'll be dealing with at the bank will still be there by the time your mortgage renews.
That's so true.
So, and that happened to me. So, the person that we signed our in person with at that time, um, they no longer, by the time our 5 year term was done and we were, or getting ready to be done and we were looking to renew, I, pulled out the guy's business card. I was like, great, I'm going to go give him a call, looked him up, and he's no longer working there. So that's also something to keep in mind when you are kind of like thinking about going bank versus broker.
Yes.
Um, and then also, I think it's really important to be respectful of everyone's time. Like, I'm respectful of my clients' time. I hope that when you are working with a broker or with the bank, you're also respectful of their time too. So keeping that in mind, like I would, if you are, shopping around and you're negotiating, I would ask, go to your bank, ask them to give you their very best rate. Like, what is the very, very best you can do for me? And then come to me and I'll see what I can do. If I can match it, beat it, if I can find a product with better prepayment privileges for you or like other solutions that might be a better fit for you, as opposed to going back and forth and back and forth and back and forth because
Yeah.
it can be a bit of a race to the bottom. And I also think, yes, banks, the big banks sometimes offer lower rates, but also you want to read the fine print. And I
So
want to say
true.
lower rates, not always,
Yeah.
sometimes. Um, so keep that in mind as well. Um, that also service levels with a broker can be better. Like I've worked with folks who at their renewal, they're like, it's been like herding cats trying to talk to my bank or get an appointment or like get find someone to talk to about the specifics of my mortgage, and I actually really, that makes me really sad because people just want to know, they just want to talk to a real person who can, tell them what their options are. So yeah, ask them for the very best thing they can do for you
Yeah.
right
Are
off the
there
bat.
any other types of questions you would recommend asking, whether it's an independent broker or even the banks?
Yeah, I would say just ensure that you understand the product that you're getting. And when I say product, I mean the type of mortgage you're getting, the what are your prepayment privileges? Like if you want to do a lump sum or if you want to like pay an extra $100 a month, is that something you can do? Can you port your mortgage? So if you end up buying a new property, can you port your current mortgage to the new property? Are there any rules around that? Um, there's also, there could be administrative fees if you decide to switch lenders. Like, what are their administrative fees at the time? So, um, that's also something to keep in mind. And some lenders have lower prepayment privileges, some have more. So that's just something to keep in mind as well.
That's
Yeah.
so true. I wanted to talk about the money side a bit. Let's say someone's like
Yeah.
living like paycheck to paycheck. They want to buy a house, but in like BC, everything's super expensive. Like, how
hmm
can someone start taking action steps now? So maybe like 3 to 5 years, they can qualify for a mortgage and start paying off debt and put in like better financial habits.
Yeah. I mean, in my ideal world, in my, utopia,
Yeah.
everybody that purchases a home would not be in any debt outside of their mortgage. But I know that's not real.
Yeah.
That's not the world we live in. Um, just because, and so what I would say is, um, you need to have a plan. Like, you need to have a plan. So when I work with clients who might not be ready to buy right now, but they want to in the future, I like to sit down with them and take a look at all of the debts that they have. Look at their income, look at what their current spending has been like, and their expenses, organize their debts by balance, highest to lowest, and also by interest rate as well. Um, and then we can sit together and come up with a plan and discuss like, so, and people get into debt for a whole variety of reasons. It's not always, frivolous spending on Ferraris and whatnot. Like sometimes it's genuinely an income issue where they are just not making enough to make ends meet and pay their, actual needs like rent, their cell phone, etc. So then we can talk about, what can we do to bring your income up? If, it's a credit issue, what can we do to bring your credit score up? Is there anything we can automate to make money management a little bit easier for you? How about we focus on one credit card at a time as opposed to making, willy-nilly random payments, which is something I often see with clients too. They don't have an actual plan to pay down the debt. It's just kind of like they're
Just minimum
paying
payments here or there.
paying minimum or even, a little bit above the minimum on every single credit card they have, just kind of hoping and praying that that will do
Something.
something.
Yeah.
So that I will work together with you to get a plan in place so that you have something to follow along with, so that every time you pay off a credit card or a debt, you get super excited and happy, and you have that rush of energy, and you apply that and transfer that to the next credit card or the next debt to pay off. So it is, I will say, really nice to go into a purchase without any credit card debt, especially at such a high interest rate, so that you can focus on other investment goals, and pay your mortgage, pay your bills, and not worry about paying high interest debt off while you're also likely going to have a higher housing cost, which can be really hard.
That really
Yeah.
makes sense. Do you find that people are just afraid to look at where they're actually spending their money and that could be like a main issue?
Yeah, I think that often sometimes folks might think they also spend less than they do,
Yeah.
and that comes as a result of not looking at your finances. If you associate your self-worth with your net worth, or how much money you have in your bank account, or what your credit score is, and when you do look at it, you feel ashamed or embarrassed, and that's totally understandable. But I really, really want to just stress and reiterate that what you see on your screen now, or what you see on your statement now, is not a forever thing. It's temporary. It's something can be done about it. And the sooner that you work on it and you build those habits, the the sooner you'll be able to grow your score, the sooner you'll be able to pay the debt off. And I think also a lot of worry and concern and shame can also come from not being aware what's happening.
So
So
true.
if you're aware of what's going on, but you have a plan and you know exactly, what your at least short-term steps are going to be, I think that clarity brings a sense of confidence too. So that's really important. Um, so I also want to add that oftentimes the things that we should be doing the most are actually the things that we are avoiding the most.
So true.
And you might be someone who, when you look at your finances, or if you even think about your finances, your body tenses up and you start getting anxiety. Maybe you start sweating. Maybe you just start like, just it gives you the heebie-jeebies.
Yeah.
Well, maybe those are actually signs that this is the thing you actually need to be working on and looking at the most. Um, and so your body is trying to protect you from it, but as a result, it's actually further perpetuating um, this scenario further along. So that is usually the thing you need to be looking at the most. Yeah.
That's such a great perspective.
Yeah, I I can't take credit for that. I read that in a book. I think it was, I can't remember the name of the book right now.
Yeah.
But if I do if I do find the title, I will make sure I let you know. But yeah, it made me really think about not just money, but as a whole, like the things in life that you might be afraid of doing the most are actually probably the things that you should be doing. Not always, but in many cases, definitely think about like the deeper reason as to why you're not, why you're avoiding. Yeah.
That's so great to hear. Yeah, it's
Hmm.
like your body gives you cues on like everything.
Yeah. And you can't listen to everything um that yourself the self-talk you have with yourself says, and that it sounds kind of counterintuitive, but like um if we listened to all of the um impulsive thoughts we had, or the impulsive things that we thought about saying or are going to say, or impulsive actions, that sort of thing, like we would be, who knows where we would be.
Yeah.
So being mindful of what is actually, what thoughts are influencing your behaviors, I think is a really important step of managing your money in the first place. So, and then from there, you can start to, and I think one, just tying it back to as far as saving for a home after getting out of debt is like, um, listen, down payment is probably one of the hardest things to save for and invest for, because it's, compared to rent or compared to a mortgage payment, it is way exponentially more of a lump sum to put up front, depending on where you live, what the cost of housing is. If you're buying, obviously, a condo versus detached is going to be a little bit different. But, you have to start somewhere, and that goes for any type of saving. Goes for any type of saving. If you even $5, obviously, saving $5 a month, it's gonna take you, however, I don't know how many years to save a down payment. I'm not trying to be, sugarcoat that. I'm gonna be real about that. But you have to start somewhere, and habits build off of that. So $5 a month, you're comfortable with that. Next month, $10. Next month, $20. Next month, $100. Next month, and so on and so on and so on. And those habits build, and you can exponentially increase your ability to save as you pay down high interest debt. You have to start somewhere.
Yeah.
You're in high interest debt, but you think you might even want to potentially buy your first home in the future, just open the FHSA.
Yeah.
Like, just open it. You don't have to contribute anything to it yet. Just open it so that you can accumulate the contribution room. Just start somewhere with that. And priorities change and situations change. So, like I said, everything is temporary with where you are now, but what you do now will ultimately influence where you'll be a year from now, 5 years from now, 10 years from now.
Totally
Yeah.
makes sense. And then in terms of like paying off debt versus like investing, what are your thoughts? Pay off debt first, right?
Depends on the type of debt.
Yeah.
I would say high interest debt, it's got to go. Like, it's got to go. It's got to go. If you're paying 20% on a credit card, it is so unlikely that any investments you make in the stock market will match those returns. It's like an immediate, if you have a 20% credit card interest rate, like, it's like, think of it as like an immediate 20% return. Doubtful you could make that on a regular, consistent basis in the
So
stock
true.
market. So there's that. And then, if you are and then there's also to consider, like, there are some people who might have like employer RSP matches. So like maybe they match it like 100% of your contribution. That's 100% return right off the bat. So
So
then
true.
that makes me think like, that's actually a better return than what I can get than the interest that I'm paying on my credit card. So if, like, for example, you sit down and you work out all of your ability to pay beyond the minimum on the credit cards, um, if you can do that and have a plan to pay down the cards while doing the employment match, I think that's kind of like a match made in heaven. Um, that's kind of the route I would go. But if obviously it's a tough time for you and you literally need every single dollar you bring in like right now, then obviously maybe don't do the match for the time being temporarily. But if you have like student loans, or maybe you have like an extremely low rate um, home equity line of credit, or a super low rate line of credit, or a super low rate personal loan, but maybe you have other debts that are higher. Like, I would really consider um, strategizing on interest rate, but also strategizing on balance too. Like, I think it is psychologically easier to pay a smaller balance than it is to pay a bigger balance. So if you have two cards, one's $2,000 and one's $20,000, but they're the same rate, I'm probably going to start with the $2,000 one
Yeah.
just because I'm probably going to pay it down faster, and I'm going to take that momentum and excitement and try and apply that to the
Yeah, the other
bigger
one.
one, as opposed to starting with the larger one, which you totally can, as that's an option, but your discipline motivation is fleeting. So I would start with the smallest one myself, and then build up that excitement for the next one. Yeah.
That totally makes sense. And what type of clients do you work with, either like money coaching or even the mortgage side?
I love um listen, we're millennials. I love my millennial friends. Um I think it's truly cool to see, where people are at different stages of their lives. So um but I'm open to working with absolutely everybody. Um, I think no matter how young or how old you are, there's always a conversation to be had about money, multiple conversations to be had about money. If you're young, maybe you have a super long investment timeline and you can be super aggressive as far as your investments. Um, Maybe if you're nearing retirement age. Now you got to think about things like, winding down. What are you going to do once your income from your job is no longer coming in? Um, but I'd also want to add, a big mistake that young people make is think that retirement is always going to be like a later thing, and to
So
not think
true.
about it
Yeah.
till later. But later is coming. Before you know it, if you don't do anything about it, later will be here. And so um, that's why I think it's so important. If you're young, if I could go back and start investing in my TFSA the moment I turned 19, I totally would. And that's probably like one of the biggest things I wish I could go back and do. So anytime I talk to young people, I'm like, you need to start investing and you need to like get this going, because there's so much opportunity out there for you.
So true.
Compound interest, your timeline, like the world is your oyster. Like, please. Um, so yeah, I love working with everybody. I think I really love, one of the best parts of what I do is um, I really get to have the opportunity to get to know people really, really well. Um, I am a Scorpio, so one of the things with Scorpios is we are very much like, we like to get really deep with people.
Yeah.
And you can't really get any deeper than money because
So
it's so
true.
personal.
Yeah.
Like I said before, like, I really don't take it lightly that people feel comfortable sharing that with me, and um, also understanding, how people have found themselves in certain situations, like the why behind maybe why they've accrued their credit card debt, and like what are some of the deep-seated reasons that they find themselves, impulsively spending, or they find themselves in situations that they felt got out of control. And then there's the other side of like maybe there's someone who is extremely financially successful, and you get to hear about how they built their business or how they got promoted or how they moved companies. And anything anything that I hear and learn along the way, I love to share, as far as not people and their confidential information, but just like the processes that I think are really interesting. Yeah.
That's so important.
Yeah.
What is the best way for our audience to connect with you and just learn more about your services?
Yes. The best way to reach out to me is on Instagram. So I am at farrahturcotte.ca. So double R in Farrah, and it's pronounced Farrah just like Sarah, but with an F. I have to throw that out there. Or you can email me hello at farrahturcotte.ca.
I'll
Yeah.
share all your details in the notes. Thank you so much, Farah, for your time.
Thank you. Thank you so much. I appreciate it.
If you're a founder who wants real strategy, not noise, and you want someone in your corner helping you build a business that feels aligned, is profitable, and actually supports your life, you can apply for CFO on Call. This is my one-on-one financial partnership for established founders, typically making between $500K to $2 million, who want clarity, who want structure and confidence with their numbers. The link is in the show notes, so you can schedule a profit strategy call, or you can DM me CFO on Instagram at It's Cindy Kumar, and I'll send over all the details.